What if I told you that the next 2 weeks could literally define the entire year for a major global commodity? Well, today we're diving into what looks like a perfect storm brewing in the silver market. Between right now and January 15th, a series of pretty unprecedented events are all lining up, and it could be some of the most important market action we see all year.
So what's the big deal about this particular time frame? It's because we're seeing a unique trifecta of market-moving events converging. I mean, three powerful forces that have never, ever collided like this in silver's history. And understanding them is really the key to figuring out where this market is headed.
And look, this is the stark warning coming from market analysts. This is not an exaggeration. The sources we're looking at are making it crystal clear. These three major catalysts are all hitting in a very, very short window. And that creates the potential for some extreme, almost unheard of volatility.
Okay, so what is actually happening here? Think of it like a massive tug-of-war between three completely different and powerful forces. You've got a mechanical force, an economic force, and a physical force, and they're all pulling the price of silver in different directions at the exact same time.
All right, let's start with the first one, the mechanical force. This is a huge pre-programmed selling event. And the most important thing to get here is that this has absolutely nothing to do with silver's actual value or what's going on in the world. It's an automatic, purely mechanical process.
So this event is called an index rebalancing. The easiest way to think about it is like your own retirement fund that automatically adjusts its holdings to stay balanced. Well, because silver had such a good run last year, its slice of the pie in the huge Bloomberg commodity index just got too big. And now the index has to sell it off to get back in line. And the sheer scale of this sell-off is, well, it's staggering. To get back to their target weight, all the funds that track this index are required by their own rules to sell over $5 billion worth of silver. I mean, that is an enormous amount of selling pressure to hit any market, let alone all at once. And this isn't random. It's not a surprise. It's a scheduled, mechanical process that's going to put significant, constant downward pressure on the price over 5 specific trading days starting on January 9th. We're talking about $1 billion a day in forced selling of contracts for future silver delivery. It's relentless.
Now for the second force, and this one is the big wild card. Crucial economic news coming from the Federal Reserve. You see, this data is going to signal the Fed's next move on interest rates, and it could either pour gasoline on a silver rally or dig a deeper hole for prices.
The entire market is going to be laser-focused on these dates, searching for clues to the big question. Is the economy finally cooling down, or is it still running a little too hot? The answer is going to have a direct, and believe me, an immediate impact on the price of silver.
And this lays out the two potential paths perfectly. It's a little counterintuitive, right? Good news for the overall economy, like strong jobs and stubborn inflation, could actually be bad news for silver, because it might force the Fed to keep interest rates high. On the flip side, signs of a cooling economy could be just the fuel silver needs to take off. Okay, so the third force, this one might be the most powerful of all, and it's rooted in the physical world. We're talking about the actual tangible supply of silver, and it's coming from the world's single largest supplier. As you can see, China is the dominant player here. They control about 2/3 of the world's refined silver. That's a huge piece of the pie. And a brand new policy that kicked in on January 1st has fundamentally changed the entire supply landscape, pretty much overnight.
And here's where it gets really intense. So just as that massive wave of $5 billion in mechanical selling is set to hit the market, the physical supply is being dramatically squeezed. China's new rules effectively cut a huge chunk of silver from the global market, creating a very real potential for a shortage and maybe even some panic buying from big industrial users who have to have it.
Hey, if you're finding this breakdown helpful, please take a moment to like, share, and subscribe to follow us. That way you won't miss any of our exciting updates.
So you've got these three immense forces colliding: the mechanical selling, the Fed wildcard, and the physical supply shock. So how does this all play out? Well, analysts have laid out 3 distinct scenarios for what could happen by the end of this critical period. Okay, scenario number 1. In this version, and according to the source material, this is seen as the most probable. The physical supply shock simply overwhelms the other 2 factors. This is the bullish case for silver. What happens here is the big industrial buyers, the ones who need physical silver for things like solar panels and electronics, they start to panic. They can't get their normal supply, so they start buying up everything in sight.
They absorb all that mechanical selling, and they drive the price sharply higher as they just scramble to get their hands on any physical metal they can find.
All right, on to scenario number 2. In this case, the powerful forces on both sides effectively cancel each other out. This leads to a period of indecision and a sideways market, basically a stalemate.
Here, the $5 billion sell-off does its job and pushes prices down. But the physical demand from buyers is just strong enough to absorb it without letting the price totally collapse. So you get this tug of war where neither the bulls nor the bears can really take control.
And then there's the third scenario. This is the bearish case. This is the perfect storm, where pretty much everything that could possibly go wrong for silver investors does, all at the same time.
In this situation, you get negative news from the Fed that spooks the market, while that huge volume of forced selling just proves to be too much to handle. The physical buyers simply can't absorb the constant day-after-day selling pressure, and it leads to a sharp and pretty painful correction.
But okay, let's zoom out for a second. Beyond this incredibly volatile 2-week window, what's the big picture look like? Well, it seems that most of the big institutional forecasts are looking right past all this short-term noise.
Despite all this potential for short-term turmoil, a lot of major analysts see significant upside for silver this year. And that suggests they believe the long-term story, the real story of supply and demand, is what truly matters, not the temporary choppiness we're about to witness.
And the reason for all this optimism is pretty fundamental. It's simple math, really. Silver is already in a long-term supply deficit, meaning we use more than we produce. And that was before the new Chinese restrictions. At the same time, demand from key industries like solar, electric vehicles, and AI is just getting stronger and stronger.
And when you look at the very long-term technical charts, we're talking patterns over decades. Some analysts project that the recent price action is part of a massive breakout pattern. Now, if this pattern holds, it could, over the coming years, lead to prices that are significantly higher than where we are today. So ultimately, the next 2 weeks will be defined by this really historic conflict. You've got the paper selling from index funds on one side versus the real physical demand from industry on the other. It is an incredible setup, and the outcome, whichever way it goes, will likely set the tone for silver for the entire year. Paper or physical, we're about to find out.